The psychology of money. Before starting the video, please like, share, and subscribe to the channel. Let's begin with a summary of Chapter 16, the bursting of financial bubbles. Chapter 16 examines the phenomenon of financial bubbles, particularly focusing on the dot-com bubble of the early 2000s and the subsequent housing market collapse. It explores the complexities behind why these bubbles occur and persist, emphasizing the interplay between human behavior and market dynamics. Key points. Impact of financial bubbles. The chapter highlights the staggering losses incurred during the bursting of the dot-com bubble, $6.2 trillion, and the housing market collapse, $8 trillion, emphasizing the profound social consequences of such financial upheavals. Greed vs. rational decision-making. While greed is often cited as a primary driver of bubbles, the author argues that this explanation is overly simplistic. Many financial decisions, even regrettable ones, are made under conditions of limited information and reasoning that seemed rational at the time. Comparative analysis. The chapter likens the rise and fall of financial bubbles to political parties, clear in hindsight but often disputed in terms of causes. Investors each hold different perspectives based on their goals, time horizons, and interpretations of asset value. Diverse investor perspectives. The concept of a singular rational price for assets overlooks the variety of investor objectives. For example, the appropriate price for a stock like Google can vary widely based on whether an investor's focus is on the short term or long term. Short-term vs. long-term strategies. The dot-com bubble showcased a shift toward short-term trading, where day traders focused on immediate profits rather than long-term fundamentals. This shift exacerbated the bubble as valuations became increasingly detached from sustainable growth. Case study: Cisco Systems. The 1999 spike in Cisco's stock price serves as an example of the disconnect between short-term momentum traders and long-term investors, illustrating how different strategies can lead to significant financial risks. Behavioral influences. Investment decisions often hinge on observing and reacting to the actions of others. When motivations behind those actions are unclear, predicting behavior becomes difficult. Therefore, understanding one's own investment strategy and resisting external pressures is critical. Clarity of purpose. The chapter emphasizes the importance of defining one's investment goals, whether for long-term growth or short-term trading. Focusing on personal objectives helps shield investors from the noise of market sentiment and potential pitfalls. Chapter 16 asserts that financial bubbles arise not solely from greed, but from a complex interplay of rational behaviors shaped by different time horizons and investment strategies. By fostering clarity of purpose and resisting external influences, investors can better navigate the challenges of financial markets and avoid the trap set by fleeting market trends. Before moving on to the next chapter, if you are enjoying this video, please subscribe to the channel. Summary of Chapter 17, Pessimism and Optimism. Chapter 17 delves into the contrasting perspectives of pessimism and optimism, exploring their psychological underpinnings and implications, particularly in the context of investing. Key points. Defining optimism. Genuine optimism is distinguished from naive positivity. It's based on the belief that, despite challenges, the odds favor positive outcomes over time. Optimists recognize setbacks but maintain a hopeful outlook for improvement. Appeal of pessimism. Pessimism is often viewed as more intellectually sophisticated and draws more attention than optimism. This tendency is not just a matter of prevalence but also relates to how pessimistic forecasts resonate with people's fears and concerns. Historical context. The chapter references a notable pessimistic forecast from December 29, 2008, during a severe economic downturn. Such dire predictions often capture public attention, overshadowing optimistic views that may seem overly simplistic. Psychological roots. Humans are naturally predisposed to prioritize avoiding losses over seeking gains, a trait that heightens the allure of pessimism. This evolutionary instinct means that warnings of doom resonate more strongly than hopeful projections. Immediacy vs. gradual progress. Financial setbacks often attract immediate attention, while positive progress is more gradual and can be overlooked. This discrepancy contributes to a focus on pessimistic narratives, as negative events are stark and undeniable. Resilience and adaptability. The chapter argues that pessimists frequently underestimate the adaptability of markets and human ingenuity. While current trends may suggest bleak futures, history shows resilience and recovery in the face of adversity. Navigating the outlooks, successfully navigating the complexities of investing requires a balance between optimism and pessimism. Acknowledging the potential for volatility and loss is crucial, even in a backdrop of growth. Irony of pessimism. Embracing a pessimistic outlook can paradoxically lead to pleasant surprises. This perspective minimizes expectations, allowing for a more manageable gap between anticipated outcomes and reality. Conclusion. Ultimately, while pessimism can be tempting, optimism serves as a beacon of hope amidst uncertainty. It reinforces the idea that, despite challenges, the future holds potential for progress and improvement. Final thoughts. Chapter 17 underscores the importance of recognizing the value in both perspectives. While pessimism may provide immediate gratification in the form of caution and awareness, optimism is essential for long-term growth and resilience in the face of life's uncertainties. Before moving on to the next chapter, if you are enjoying this video, please subscribe to the channel. Summary of Chapter 18. Transformation. Chapter 18 explores the contrast between perception and reality in economic narratives, highlighting how our beliefs shape financial outcomes and decisions. Key points. Alien perspective. The chapter opens with a hypothetical scenario in which an alien observes New Year's Eve celebrations in New York City in both 2007 and 2009. While the physical landscape appears unchanged, the underlying economic realities have drastically shifted, with households becoming $16 trillion poorer and unemployment soaring. Narratives over tangibles. The significant change from a narrative of growth and stability in 2007 to one of doubt and uncertainty by 2009 illustrates that economic outcomes are often driven more by the stories we tell ourselves than by tangible factors. Our beliefs and expectations can trigger real economic consequences. Psychology of storytelling. Human psychology leans towards narratives that align with our desires and aspirations. We often cling to appealing stories, whether in investment advice or personal finance, which can lead to poor decision-making when those narratives are misleading. Desire for control. In uncertain environments, there's a strong desire for forecasts and predictions to provide a sense of control. However, these forecasts often lack accuracy. The chapter emphasizes that seeking certainty in the unpredictable world of finance can lead to misguided beliefs. Constructing narratives. Our understanding of the world is inherently limited, shaped by personal experiences. We construct narratives to make sense of uncertainty, frequently overlooking the role of chance and external influences that are beyond our control. Embracing humility and skepticism. The chapter advocates for recognizing the limitations of our knowledge and the power of compelling narratives. By maintaining humility and skepticism, we can avoid being misled by appealing fictions and make better informed financial decisions. Conclusion. The most compelling stories are not always grounded in reality. Understanding the influence of narrative on our perceptions and actions can help us navigate the complexities of finance and economics with greater clarity and caution. Final thoughts. Chapter 18 emphasizes the importance of critically assessing the narratives that shape our understanding of economic realities. By doing so, we can become more resilient and make informed decisions in an unpredictable financial landscape. Before moving on to the next chapter, if you are enjoying this video, please subscribe to the channel. Summary of Chapter 19. Truth. Chapter 19 offers a consolidation of insights and key takeaways from the financial journey discussed throughout the book, emphasizing the importance of personalizing financial advice and decision-making. Key points. Cautionary tale. The chapter opens with the story of Clarence Hughes, whose tragic experience following a dental procedure highlights the need for autonomy in decision-making, whether in healthcare or finance. This serves as a reminder that advice must be tailored to individual circumstances. Shift to patient-centered care. Just as the medical field has moved towards shared decision-making, the financial industry must also adapt to recognize the unique goals and preferences of each client. Financial advisors should combine their expertise with empathy and humility. Universal versus personal truths. While there are universal principles in finance, the application of these principles should reflect personal values and circumstances. Recommendations for enhancing financial acumen. Embrace humility. Understand the complexity of finance and the role of luck and risk in success and failure. Cultivate long-term thinking. Recognize that time is crucial for investment growth and for mitigating mistakes. Accept setbacks. Focus on overall portfolio performance rather than getting bogged down by individual investments. Prioritize control over time. This is essential for achieving happiness and fulfillment. Practice kindness and modesty. Building genuine connections is more valuable than accumulating material possessions. Save diligently. Saving should not only be goal-oriented but also act as a buffer against life's uncertainties. Acknowledge hidden costs. Be prepared for the uncertainty and regret that accompany success. Maintain a margin of safety. Protect against extreme risks that could jeopardize your future. Define your financial game plan. Align your actions with your unique aspirations and values. Embrace diversity of opinion. Recognize that there is no one-size-fits-all approach to wealth management. Final thoughts. Successful financial management is a personal journey marked by self-awareness, adaptability, and continuous learning. By finding what works best for you and remaining open to diverse perspectives, you can navigate the complexities of finance with confidence and clarity. The chapter concludes with a personal reflection on what guides the author in this journey, reinforcing the idea that financial wisdom is a deeply individual pursuit. Before moving on to the next chapter, if you are enjoying this video, please subscribe to the channel. Summary of Chapter 20, Path. Chapter 20 focuses on Sandy Gottman, a billionaire investor known for his insightful approach to investment philosophy. His signature question during interviews, "What do you own and why?" serves as a lens into understanding personal investment choices and the disconnect that often exists between advice and actual practice. Key insights. Investment philosophy. Gottman's question encourages candidates to reflect on their real investments rather than hypothetical scenarios. This highlights a broader issue. Many mutual fund managers do not invest their own money in the funds they manage, revealing a gap between advice and personal practice. Personal values. Financial decisions are deeply intertwined with personal values and priorities. They shouldn't just aim for maximum returns but should align with an individual's comfort and peace of mind. Financial independence. Gottman emphasizes the importance of living below one's means and maintaining a high savings rate to achieve financial autonomy. His upbringing instilled a sense of frugality that prioritizes stability over consumerism. Investment strategy. His approach has shifted from stock picking to low-cost index funds, advocating for simplicity and long-term stability. He acknowledges the temptation of active investing but focuses on savings and patience instead of market timing. Mastering money psychology. Ultimately, Gottman's philosophy revolves around understanding the psychology of money and prioritizing independence, illustrating that financial success is a personal journey defined by individual fulfillment and security. Postscript. Evolution of the U.S. consumer mindset. The postscript examines the evolution of the American consumer mentality from the post-World War II era to the present day, emphasizing how historical events and cultural shifts have shaped consumer behavior. Key points. Post-war uncertainty. 1945, returning soldiers faced housing shortages and a shift to civilian jobs, creating economic uncertainty. Low interest rates and consumerism policies that encouraged consumer spending, including the GI Bill, led to increased home ownership and rising consumer debt. Pent-up demand and economic boom. The post-war period saw a surge in consumption and job creation due to wartime innovations. Rise of inequality. 1970s onwards, economic gains began to concentrate among top earners, contrasting with the previous era's shared prosperity. Cultural shifts. Expectations of equality and lifestyle parity clashed with the reality of growing inequality, leading to discontent. Debt and financial crisis. 2008, the easy access to credit masked underlying economic challenges, with the financial crisis revealing the fragility of this model. Contemporary challenges. Political movements like the Tea Party and Occupy Wall Street arose in response to economic insecurity and inequality. Impact of technology. The internet and social media heightened awareness of socioeconomic disparities, amplifying calls for change. Future prospects. Despite cyclical economic trends, Past expectations continue to shape consumer behavior and political discourse, with a persistent gap between expectations and reality. Conclusion. Chapter 20 underscores the importance of aligning financial decisions with personal values while reflecting on how historical and cultural factors have shaped consumer psychology in the U.S. It emphasizes the complexity of individual financial journeys and the necessity of understanding personal motivations in navigating the financial landscape. If you are enjoying this video, please subscribe to the channel.